Imagine if the smartest minds in finance, 2 Nobel Prize winners, created a money-making formula and then lost $4.5 billion in just 4 weeks. This same formula still controls how your retirement, your 401k, even your savings may be managed today. And it could be quietly draining your wealth. In this video, you'll see exactly how their genius failed and how you can protect your money using lessons learned the hard way on Wall Street. Stay to the end because I'll reveal the one hidden flaw in this system that nearly caused a global collapse and how to spot it in your own investments. If you're someone who wants to understand how the financial elite really operate, not the myths, but the math, then this channel is your insider's guide. Welcome to the Wealth Project, where ambition meets opportunity and your journey to wealth and luxury living truly begins. Here, we deconstruct the playbooks of the world's most successful so you can transform your future. If you're ready to elevate your life, subscribe, follow, and ring the bell so you never miss a masterclass. Welcome to the exclusive club, where you don't just watch, you learn to win. Your next lesson starts now. Today you're going to hear the true story of a hedge fund built by Nobel Prize winners who believed they had cracked the code to risk-free investing. They turned $1 billion into $5 billion using pure math. Then they lost it all. And the scary part? Their method still influences how billions of dollars are invested every day. By the end of this video, you'll know how to recognize the psychological trap that destroyed them and how it might already be hurting you. The dream team that conquered Wall Street. In 1994, John Meriwether assembled the Financial Avengers. He recruited Myron Scholes and Robert Merton, 2 professors who would win the Nobel Prize for creating the Black-Scholes formula. This was the holy grail of finance, a formula that could supposedly eliminate risk forever. When they launched with $1.25 billion, every major bank begged to give them money. Goldman Sachs, Morgan Stanley, Chase, they all wanted in. These weren't just smart guys with theories. These were the people who wrote the textbooks every finance student studies. Their strategy seemed foolproof. Convergence arbitrage, like finding identical cars at different prices across town. Buy the cheaper one, sell the expensive one, knowing prices would meet in the middle. They did this with bonds and stocks, using supercomputers to spot tiny differences regular investors couldn't see. This strategy worked beautifully for 4 years, making them legends. But there was a fatal flaw hidden in their perfect system. So dangerous, it would require the Federal Reserve to prevent global economic meltdown. But first, you need to see just how successful they became. The money printing machine. For 4 years, LTCM was Wall Street's money printing machine. 1994, 20% return. 1995, 43% return. 1996, 41% return. 1997, 17% return. By early 1998, they managed over $100 billion with less than $5 billion of their own money. They had borrowed 20 times their capital. But here's what made them dangerous. They believed their own hype. The Nobel winners convinced themselves they had created a self-correcting portfolio. Their models showed their bets were uncorrelated. If one lost money, another would profit to balance it out. Success breeds confidence, and confidence breeds arrogance. They saw themselves not as traders, but as scientists who had discovered financial physics laws. This intellectual arrogance was about to meet something their models never accounted for: human panic. But to understand how devastating this would be, you first need to see the warning signs they completely ignored. The first warning shot. In July 1997, Thailand's government devalued its currency, triggering the Asian financial crisis. For the first time, LTCM's uncorrelated investments moved in the same direction. against them. When panic hits markets, investors don't think rationally. They run for safety, selling risky assets for U.S. Treasury bonds. This broke LTCM's models. Their programs assumed people would act logically, that prices would naturally correct themselves. But fear doesn't follow mathematical formulas. The fund lost money, but the partners remained confident. They viewed the Asian crisis as a temporary anomaly that would soon correct itself. This was their first major mistake, confusing their models with reality. But the Asian crisis was just a warning shot. What happened next exposed the fatal flaw in their entire system, so devastating it would wipe out 4 years of genius in just 4 weeks. This same flaw exists in most people's investing approach today. The day everything broke, August 17th, 1998. The Russian government did something LTCM's models calculated as virtually impossible. They defaulted on their government bonds. The effect was catastrophic. The flight to safety became a global stampede. Panicked investors sold risky assets and piled into treasury bonds. This caused price gaps in LTCM's trades to widen dramatically instead of converging. On August 21st, just 4 days later, LTCM lost $553 million in a single day. Traders sat frozen watching screens turn red. Phones rang with margin calls. The Nobel winners, who had been treated like gods, were watching their life's work evaporate. By August's end, $1.85 billion lost, 44% of their capital in 1 month. September was worse. The losses accelerated like a runaway train. In 4 weeks, over 90% of the fund's capital vanished. But the real catastrophe wasn't just their failure. It was what their collapse was about to do to the entire global economy. This reveals the most important lesson about hidden risk: the near collapse of everything. Here's what the Nobel winners failed to understand. They weren't just risking their own money. Because they had borrowed from every major Wall Street bank, their collapse threatened a chain reaction that could cripple the global financial system. If you owe the bank $1,000, you have a problem. If you owe $100 billion, the bank has a problem. LTCM owed everyone. The Dow had fallen 20% from its July peak. Major banks faced massive losses. The financial system was freezing up. If you had retirement savings with these banks, your future was suddenly at risk because of decisions by people you'd never heard of. On September 23rd, the Federal Reserve orchestrated an unprecedented bailout, forcing 14 Wall Street firms to inject $3.6 billion. The original partners were wiped out. This bailout prevented global meltdown, but revealed something terrifying about our financial system. Understanding this is key to protecting your wealth from similar catastrophes. 3 lessons that could save your financial future. The psychological trap that destroyed LTCM destroys individual investors every day. Lesson 1. Never confuse models with reality. The Nobel winners created beautiful models, but forgot markets are made of people, not equations. When panic hits, people don't behave rationally. Never put all faith in any single strategy. Markets can stay irrational longer than you can stay solvent. Lesson 2. Leverage amplifies everything. LTCM's massive borrowing turns small gains into huge profits, but small losses into total destruction. Be extremely careful with debt. Whether credit cards, margin trading, or mortgages, borrowed money amplifies both gains and losses. True scarcity comes from owning assets outright. Lesson 3. Hubris is the ultimate risk. The most dangerous moment is when you think you've figured it all out. The market doesn't care about your IQ or past success. The best investors stay humble. The moment you think you can't lose is when you're most likely to lose everything. Which of these 3 lessons do you see reflected in your own financial strategy right now? Trusting models too much? Over-leveraging? Or underestimating risk? Drop your insights in the comments. I read them And you'd be surprised how much you can learn just by thinking through your own answer. This story wasn't just about one hedge fund. What happened to long-term capital management has repeated again and again, from the 2008 crash to crypto wipeouts. And the same psychology is always at play. And here's the truth. Understanding these patterns is what separates regular investors from the ultra-wealthy. I've got stories of billionaires, secret strategies, and psychological tricks that big money uses, all coming up in future videos. Luxury, freedom, and success are closer than you think. Don't just watch, take your next step. Choose our latest insights or a curated favorite, both waiting for you on your screen. This is the Wealth Project, deconstructing wealth, transforming your future. Subscribe, get the rulebook, and remember, you're now part of the exclusive club, Playing to Win.